Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. The Federal Reserve's pivot to a hawkish hold is the dominant force reshaping portfolios right now. After months of speculation around rate cuts, the Fed has paused its easing cycle through mid-2026, and market pricing now reflects zero cuts expected this year. According to VanEck, improvements in economic data have pushed rate cut expectations all the way out to mid to late 2027. That's a massive shift from earlier projections, and it's forcing a complete recalibration across equities, fixed income, and alternative assets. Let's start with why this pause happened. Nuveen's latest research highlights two primary catalysts: persistent inflationary pressures driven by rising global energy prices and ongoing geopolitical uncertainties, particularly developments in the Middle East. The Fed's official statement language has hardened. Where previous communications acknowledged inflation was moderating, the current stance notes that inflation is elevated. That's a clear signal the central bank isn't ready to ease, and traders need to adjust expectations accordingly. Matthew Dixock, head of CIO cross-asset market strategy at VanEck, stated that markets no longer expect rate cuts this year. The data backing this includes sticky inflation readings and stronger than expected employment figures that give the Fed cover to hold rates higher for longer. This environment is fundamentally different from the easing cycles we've seen in prior years, and it demands a different playbook. So what does this mean for equities? Growth stocks are taking the hit. Technology, communication services, and consumer discretionary sectors, those with long-duration cash flows, are under pressure because higher discount rates compress their present valuations. When rates stay elevated, the future earnings that justify high multiples get discounted more heavily. BlackRock's strategy analysis confirms this dynamic. While equities typically rally when discount rates fall, a pause or reversal in that trend removes a key support pillar for growth-heavy portfolios. The flip side is value stocks and shorter duration equities are starting to shine. Companies with near-term cash flows and tangible earnings power become relatively more attractive as risk premiums adjust. We're seeing sector rotation out of high-flying tech names and into financials, energy, and dividend-paying value plays. This isn't a wholesale abandonment of growth, but it's a rebalancing that reflects the new rate reality. J.P. Morgan Global Research projects equity upside ranging from 10% to 25% under scenarios of robust earnings and improved fiscal support. But that upside is conditional on companies delivering earnings growth that justifies current valuations in a higher rate world. The bar is higher, and misses will be punished more severely than in a falling rate environment. Now let's talk bonds. The fixed income reaction has been immediate and sector specific. Nuveen reports that through April 2026, the Bloomberg U.S. Corporate High Yield Total Return Index was up 1.3% year-to-date, outperforming similar duration treasuries by 75 basis points. High yield is outperforming because investors are hunting for yield in a world where the Fed isn't cutting rates anytime soon. The risk-on appetite in credit markets reflects a bet that corporate balance sheets can handle higher rates without a wave of defaults. The yield curve is also adjusting. iShares analysis indicates the pause in rate cuts is pushing the curve toward flattening, especially as long-dated bonds lose favor. Tactical positioning is shifting away from bonds with maturities greater than 10 years. The reason is simple. If rates stay higher for longer, long-duration bonds face continued price pressure. Shorter duration bonds, those under 10 years to maturity, are the sweet spot right now, offering yield without excessive interest rate risk. This is a reversal from the prior easing phases when long-duration bonds rallied hard on falling rates. The playbook has flipped. Traders who rode the duration trade down need to exit or reposition because the Fed's hawkish hold means that rally is over for the foreseeable future. Sector rotations are accelerating beyond just growth versus value. Charles Schwab and J.P. Morgan Research both highlight a shift toward alternative income strategies. Traditional bonds and cash instruments are being diversified into private credit and dividend-focused equities. Private credit, in particular, is attracting institutional and retail flows because it offers floating rate exposure that benefits from a higher rate environment, unlike fixed-rate bonds. Alternative assets are also in focus. Kavut's analysis notes that as bond coupon yields decline, or in this case, as the expected path of declining yields gets pushed out, non-yielding assets like gold become more attractive. The opportunity cost of holding gold drops when the alternative is cash or bonds yielding less than expected. Gold has shown resilience in this environment, and it's being positioned as a hedge against both persistent inflation and geopolitical risk. Bitcoin and crypto are another angle. While Bitcoin doesn't offer a yield, its appeal as a non-correlated asset and inflation hedge has gained traction in a higher-for-longer rate world. The crypto narrative is shifting from a speculative growth play to a portfolio diversifier. Institutional adoption continues, and as traditional fixed income offers less relative value, allocations to digital assets are growing, albeit cautiously. Key economic data releases are now the primary drivers of short-term volatility. Upcoming Federal Open Market Committee minutes and pivotal data on employment, inflation, and energy prices will shape whether the Fed holds firm or signals any shift. Right now, the consensus from VanEck and Bank of America Global Research is that cuts are unlikely until well into 2027. But if inflation cools faster than expected or employment weakens materially, that timeline could accelerate. Energy prices remain a wild card. Rising oil prices driven by Middle East tensions and production constraints are a direct input into inflation. If energy costs spike further, the Fed's hand is forced to maintain its hawkish stance even longer. Conversely, a resolution or easing in geopolitical tensions could bring energy prices down and open the door for a sooner pivot. For portfolio positioning, the takeaway is clear. Diversification and duration management are critical. Overweight positions in long-duration growth stocks and long-dated bonds are vulnerable. The opportunity set is shifting toward value equities, shorter duration fixed income, high-yield credit, and selective alternative assets including private credit, gold, and crypto. Sector-specific plays matter more in this environment. Financials benefit from a steeper net interest margin in a higher-rate world. Energy continues to perform on tight supply and geopolitical risk. Healthcare and utilities offer defensive characteristics with dividend support. On the flip side, high-multiple tech and consumer discretionary names need strong earnings beats to justify current prices. Fixed income strategy should focus on credit quality and duration. High-yield credit is outperforming, but selectivity is key. Defaults will rise if the economy slows while rates stay high. Investment-grade corporates with shorter maturities offer a balance of yield and lower volatility. Avoid the temptation to chase yield in overly risky credits without understanding the default risk in a prolonged high-rate scenario. The macro backdrop is one of resilience but caution. The Fed's hawkish hold reflects an economy that's proven more durable than expected, but also one where inflation hasn't been fully tamed. The longer rates stay elevated, the greater the risk of an eventual slowdown or credit event. Positioning for that tail risk while capturing current opportunities is the balancing act every trader faces right now. Monitoring the data is non-negotiable. Employment reports, CPI and PCE inflation prints, and energy market moves will dictate Fed trajectory and market reactions. Nimbleness and the ability to adjust positioning as data evolves will separate winners from losers in this environment. Bottom line, the Fed's pause on rate cuts through mid-2026 and the market's repricing of cuts to late 2027 is a regime shift. Growth stocks face headwinds, value and dividend plays are gaining, bond duration is shortening, high-yield credit is outperforming treasuries, and alternative assets are carving out a larger role in portfolios. This is a higher-for-longer world, and your portfolio strategy needs to reflect that reality. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.